It's a Tuesday afternoon, and you're sitting at your kitchen table with your laptop open, looking at your mortgage account. And after years, maybe decades of payments, you're about to make the last one. You hover over the button, you click it, and just like that, it's done. You own your home. Free and clear, no bank, no lender, no monthly payment hanging over your head ever again. You feel lighter than you've felt in years. You might even tear up a little. You want to call someone, tell somebody, maybe burn the mortgage statement in the backyard like people do in the movies. Sound familiar? Or at least sound like something you desperately want to feel one day? Well, what if I told you that there's a real chance that exact moment, that beautiful, emotional, hard-won victory, could quietly be one of the most expensive financial decisions you ever make? That the money you poured into killing that mortgage early might have cost you $200,000, $300,000 or more in the long run? Most people treat paying off the mortgage as the holy grail of personal finance, the ultimate win, the thing every responsible adult is supposed to chase. But here's something that might surprise you. A mortgage might be the single best, cheapest, most useful debt you will ever have access to in your entire life. And rushing to get rid of it could be working directly against you. If you've ever felt that pull to throw every spare dollar at your mortgage just to be free of it, make sure to hit that subscribe button and give this video a thumbs up if it helps you see this decision a little more clearly. Now, before we get into why paying it off early can be a mistake, let me sit with you in the feeling first, because the feeling is the whole reason this is so hard. Carrying a mortgage is heavy. You know that feeling on the first of the month when the biggest single payment of your life leaves your account and some quiet part of your brain whispers, you don't really own this place, the bank does. You're just renting it from them at a very high price, and if you miss enough payments, they'll take it. There's something almost primal about owing money on the roof over your head. It follows you around. You make a great salary. You've got money in the bank, and yet there's this six-figure number sitting in the background of your life with your name on it, and it just feels wrong, like a weight you'd give almost anything to put down. So you start fantasizing about it. You run the numbers on what would happen if you threw an extra $1,000 a month at it. You imagine the day it hits zero. And honestly, that instinct comes from a good place. It comes from wanting security, wanting freedom, wanting to not owe anyone anything. Those are beautiful instincts. But here's the thing about instincts and money. They were built to keep you safe, not to make you wealthy. And sometimes the very instinct that feels the safest is the one quietly costing you the most. So let's get into it. And I want to start with the single most important factor in this entire decision. The one thing that determines whether paying off your mortgage early is brilliant or foolish. It's not your income. It's not your age. It's your interest rate. Here's why. When you pay extra money toward your mortgage, you're not earning anything in the traditional sense. What you're actually doing is avoiding the interest you would have paid. So if your mortgage charges you 4%, every extra dollar you throw at it effectively earns you a guaranteed 4% return, because that's the interest you're no longer going to pay. That's the real math of paying down debt. Your return is exactly equal to your interest rate. Now hold that next to the other thing you could do with that same dollar. Invest it. Historically, the stock market has returned somewhere around 10% a year on average over the long run. And even if we're being conservative and knock that down to 7% to account for inflation and bad decades, that's still a lot more than 4%. So picture two identical people. Both have an extra $1,000 a month. One of them spends the next 25 years aggressively paying down a 3.5% mortgage. The other invests that same $1,000 a month into a simple index fund earning around 7%. After 25 years, the person who paid down the mortgage has effectively put themselves ahead by around $480,000 in avoided interest and equity. Sounds amazing, until you see the other one. The person who invested instead is sitting on roughly $810,000. That's a difference of more than $300,000 from the exact same $1,000 a month. The only thing that changed was where it went. That gap, that enormous life-altering gap, is what economists call opportunity cost, which is just a fancy way of saying the cost of what you gave up. And it's the most invisible cost in all of personal finance, because you never see a bill for it. Nobody sends you a statement that says, here's the $300,000 you missed out on by playing it safe. The money just quietly never shows up. Now, if I stopped right there, I'd be doing exactly what a lot of finance bros do, which is wave a big scary number in your face and pretend the decision is obvious. It isn't. So let me be fair to the other side, because the other side has a real point. That 4% from paying down your mortgage, it's guaranteed, locked in. There is no version of the future where you pay down your mortgage and it doesn't work. The 7% from the market is not guaranteed. It's an average, and averages hide some genuinely terrifying years. The market can drop 30% and stay down for a while. It can test your nerves in ways a mortgage never will. So this isn't actually a fair fight between 4% and 7%. It's a fight between a sure thing and a probably better thing. And how you feel about that trade-off depends a lot on who you are. A guaranteed return that lets you sleep at night has real value, and anyone who tells you that peace of mind is worthless has clearly never lain awake at 3 in the morning doing math about their bank account. So I'm not saying saying the math is the only thing that matters. I'm saying you should at least know what the math is, so that if you choose the guaranteed path, you're choosing it on purpose, with your eyes open to what it costs, instead of just following an instinct and assuming it was free. Now here's an angle that almost nobody talks about, and it might be the most important one in this entire video. When you pour extra money into your mortgage, you are taking cash, flexible, liquid, do anything cash, and you are turning it into something you cannot easily touch. Think about what actually happens. You send the bank an extra $50,000 over a few years. That money is now equity in your house. It's in the walls. It's in the foundation. And here's the cruel part. You can't get it back out without either selling the house or borrowing against it, which means qualifying for a loan, paying fees, and convincing a bank to give you your own money back. Now imagine life happens. You lose your job, there's a medical emergency, the economy turns, and your industry gets hit. You've got this beautiful house that you're way ahead on, and almost nothing in your checking account because you sent it all to the bank. And here's the thing that shocks people. The bank does not care that you're $50,000 ahead on your payments. If you can't make this month's payment, you are in just as much trouble as someone who never paid a dollar extra. Being ahead doesn't buy you a free pass. The mortgage company wants this month's money every month, no matter how far ahead you got. Compare that to the person who invested their extra money instead. They've got a brokerage account they can tap in a few days if disaster strikes. They have options. They have breathing room. So here's the paradox that breaks people's brains. Aggressively paying off your mortgage early can actually make you less financially secure, not more, because you've traded your safety net for a number on a statement you can't spend. I know someone who learned this the hard way. They'd thrown every spare dollar at their mortgage for years, felt great about it, and then got laid off and realized they had a nearly paid off house and almost no cash to actually live on while they job hunted. House rich, cash poor, and stressed out of their mind. Liquidity, having money you can actually reach, is one of the most underrated forms of wealth there is, and prepaying your mortgage quietly destroys it. Here's another angle that flips this whole thing on its head, and once you see it, you can't unsee it. Your mortgage payment is fixed. If you owe $2,000 a month, you'll owe $2,000 a month in year 1, in year 10, in year 30. The number never changes, but the value of that number changes enormously. Because of inflation, $2,000 30 years from now will feel like almost nothing compared to what it feels like today. At a modest 3% inflation, that same $2,000 payment will feel like about $820 in today's money by the end of a 30-year mortgage. You'll be paying it with future dollars. Dollars from a future where your salary has gone up, where prices have risen, where $2,000 is what people spend on a nice weekend. This is one of the strangest and most beautiful things about a long fixed rate mortgage. It's a debt that quietly shrinks in real terms every single year, all on its own, while you do nothing. You are paying back tomorrow's cheap dollars for a house you're living in today. Rushing to pay it off early means giving up that gift. Voluntarily handing over today's valuable dollars to erase a debt that inflation was already busy erasing for you. Now here's a belief I want to gently take apart, because a lot of people hold it without realizing it. There's this quiet assumption that a paid-off house is somehow working harder for you, or growing faster, or doing more. It isn't. Your home appreciates at exactly the same rate whether you owe $400,000 on it or nothing at all. If houses in your area go up 5% this year, your house goes up 5% regardless of your mortgage balance. The growth of the asset has nothing to do with how much of it you've paid off. So paying down your mortgage doesn't make your house grow faster. All it does is change how much of that house you've already bought with cash versus how much you're still financing. And when your financing is cheap, when you've got a low fixed rate locked in, keeping that financing in place and letting your other money grow somewhere with a higher return is mathematically just the better use of a dollar. The house grows either way. The question is only what your spare cash is doing in the meantime. So if the math is often this clear, why do so many smart, careful people still rush to pay off their mortgages? And the answer is a beautiful little quirk of human psychology called loss aversion, which is the well-documented fact that human beings feel the pain of a loss about twice as strongly as we feel the pleasure of an equal gain. Here's how that plays out. Mortgage interest feels like a loss. Every month, you watch money leave your account and disappear into a bank, and it stings. It feels like bleeding. So your brain screams, make it stop. Meanwhile, the gains you'd get from investing that money instead are abstract, far away, and uncertain. They live in a spreadsheet in a future you can't quite picture. So your brain weighs a vivid, painful, certain loss against a fuzzy, distant, uncertain gain, and it picks stopping the pain every single time. It's the same reason people will obsess over a small, annoying fee while ignoring a much larger opportunity they can't see. The pain of the visible thing simply overwhelms the math of the invisible thing. Paying off your mortgage feels like stopping a wound from bleeding. Investing feels like maybe, possibly planting a seed. Of course, people choose the bandage. It's human. It's just not always rich. Okay, I've spent a lot of this video making the case against paying off your mortgage early, so now let me get genuinely honest with you, because this is where the internet's finance gurus usually fail you. There are real, legitimate situations where paying off your mortgage early is absolutely the right move, and pretending otherwise would be dishonest. The first and biggest one is your interest rate, which brings us right back to where we started. Everything I've said assumes your mortgage is cheap. If you locked in a 3% rate a few years back, paying it off early is mathematically pretty hard to justify. But if your rate is high, if you're sitting at 7% or more, the entire calculation flips. Because now you're comparing a guaranteed 7% from paying it down against a hoped-for 7% from the market that isn't guaranteed at all. And a sure 7 beats a maybe 7 almost every time. At high rates, paying down your mortgage isn't dumb. It might be the smartest, safest return available to you anywhere. The second situation is simply who you are. If you know yourself and you know that you won't actually invest that extra money, that it'll just leak out into a nicer car and more dinners out, then paying down the mortgage might be your best realistic option, because a guaranteed 4% you actually capture beats a theoretical 7% you never do. The best financial plan isn't the one that's perfect on paper. It's the one you'll actually follow. And the third is purely emotional, and I want to validate it completely. If being debt-free would genuinely change your life, if it would let you breathe, sleep, take a risk, leave a job you hate, stop the 3 a.m. anxiety, then that peace of mind has real, legitimate value, even if it costs you money. You are not a spreadsheet. There is no return on investment high enough to justify being miserable for 30 years. If you've run the numbers, you understand what you're giving up, and you still want that feeling of owning your home outright. That is a completely valid choice. Just make it as a choice, not as a reflex. I want to come back to that opportunity cost one more time, because I don't think the raw number really lands until you make it personal. We said the difference between paying down a cheap mortgage and investing instead could be over $300,000 across the life of a loan. So let's talk about what $300,000 actually is. That's not just a bigger number on a screen. That's years of your life back. That could be retiring early. That could be a paid-for college education for your kids so they don't start their adult lives in debt the way so many people do. That could be the cushion that lets you walk away from a toxic job, or start the business you've always talked about, or simply never feel that grocery store math anxiety again. And here's the part that makes it real. That money doesn't come from working harder, or earning more, or getting lucky. It comes purely from the decision about where you pointed dollars you were already going to save. Same effort, same income, same discipline, wildly different outcome, decided by one quiet choice most people make on autopilot, based on a feeling without ever running the numbers. That's the thing about compounding. It rewards the boring, invisible decision you make today and pays it out enormously decades from now when you've almost forgotten you made it. So there you have it. Paying off your mortgage early isn't actually the obvious no-brainer financial win that everyone treats it as. It's a trade-off, a real one, with a real cost. And whether it's brilliant or foolish comes down to your interest rate, your need for cash you can actually reach, the gift inflation is quietly handing you, and the simple human question of what lets you sleep at night. If you've already paid off your mortgage, please don't sit there feeling bad about it. You didn't make a catastrophic mistake. You made a choice that bought you a real, genuine feeling of security, and that feeling has value. All I want is for you to understand the trade-off. So the next big money decision you make is one you've actually thought through instead of one you inherited from people repeating what their parents told them. Because here's the subtle truth underneath all of this. The goal was never really to be debt-free. The goal was to be free. And those two things sound identical, but they are not the same. Being debt-free is a number on a statement. Being free is having options, money you can reach, a future you can shape, and the breathing room to live the life you actually want. Chase the freedom, run the numbers, and let the mortgage be what it was always meant to be. Not a weight to panic about, but a tool. Quite possibly the best one you'll ever have.